Hello, and welcome to the Star Group Wealth Management webinar series. Our topic today is the One Big Beautiful Bill Act, and I'm your host, Leslie Stock Lopez, President and founder of Star Group Wealth Management. So the One Big Beautiful Bill Act was signed in July of 2025, and it does have implications to investors, and that's what we're focusing on today. Although the bill is 870 pages, we won't be going through all of those items within the bill, but we will be focusing on those that impact financial planning, estate planning, and taxes. Before we get started, it's good to note that Star Group Wealth Management and LPL Financial do not provide tax, accounting, or legal advice, and clients should consult their own independent advisors as to tax, accounting, or legal statements made here within. Our sources for the presentation are many investment firms, Morningstar, MFS, Nationwide, and LPL Financial, as well as the Tax Foundation and the Internal Revenue Service. Our agenda, simple. We'll be talking about the Big Beautiful Bill, and I'm going to be calling it the Act or the Bill just to shorten it. We'll be talking about the taxes, the estate planning effects, and then also the new deductions and opportunities that have come out of the bill. First, we'll talk about tax brackets and the higher standard deduction, which were made permanent. The Tax Cut and Jobs Act, which was enacted in 2017, reduced the tax brackets to the 7 brackets that you see here at the top bullet: 10, 12, 22, 24, 32, 35, and the top bracket at 37. Those were temporary and set to sunset at the end of this year, which would have meant higher taxes for all tax-paying Americans if they were to revert back to the 2016 rates. So now those have been made permanent. We also have the higher standard deduction, and that has been made permanent as well. Prior to the Tax Cut and Jobs Act, the majority of Americans, well, probably about half of Americans were itemizing, and the other using the standard deduction. Well, now with that higher standard deduction, that amount is 90% of individuals that are using that higher standard deduction. So that has been made permanent. Miscellaneous itemized deductions that were suspended have now been suspended permanently. And then also in 2026, the 10 and 12% brackets are slightly larger, so more income is taxed at a lower rate, reducing overall taxes for most Americans. Families have also received some benefits. The child tax credit has been made permanent, and that's increasing starting in 2026, going from $2,000 this year to $2,200. Starting in 2026, there's now a child care credit, and that helps low-income families pay for child care. Now, a temporary deduction is for state and local taxes, sometimes called SALT, and they've been raised from $10,000 to $40,000. So for those who live in states that have high property taxes, this can be beneficial, but it's only good for itemized filers. So for an example, in 2025, the maximum deduction would be $40,000. But again, there is some phase outs. So it's good to note that incomes over $600,000 aren't able to take advantage of this increased maximum deduction. Now, this will sunset in 2029. So starting in 2030, it will revert back to a maximum deduction of $10,000. Estate planning, certainly there's impacts there. So the tax exemption for estate planning now has been increased to 15 million, and that has been made permanent. Again, that was set to sunset at the end of this year. And what that does is it reduces estate tax concerns for many Americans and allows them not to have to rush into gifting or setting up irrevocable trusts. If you look at the little box below, the top estate tax rate is at 40%, and that will remain for 2026. But it could have changed if it had sunsetted and the bill was not signed. Could have gone back to 2016 rates or even to 2004 rates, which had that top tax rate at 48%, and the exclusion amount was 1.5 million instead of 15 million. Just as an example, if an estate was worth 1.5 million, a person passed on, their heirs would be reduced, that 1.5 million would be reduced by 720,000, which would be that 48% tax cut. So there are new deductions and opportunities available to individuals through the bill. There's the Social Security or age 65 deduction. There's 529 plans have been expanded. Auto loan interest rates have been added. No tax on tips or overtime pay. The new Trump account, and then charitable deductions and credits. We're going to go over each one of these new deductions. So because of the way the bill was signed, it had to use reconciliation. They were unable to make a tax cut to Social Security. So they call this the Social Security deduction. However, you don't have to be on Social Security in order to qualify. This is also a temporary deduction, years 2025 to 2028. So anyone age 65 or older qualifies. You don't have to be on Social Security. And if you're married, you must file a joint return to claim the deduction. The maximum amount of deduction is $6,000 per person. But there are some restraints. If your income as a single filer is over 75,000, it starts to phase out, meaning that 6,000 reduces until it's completely phased out at 175,000. For a married couple, that phase out is 250,000. So let's do an example of an individual who's age 65, whose income is under 75,000. They get the standard deduction of 15,750. Then they also have the current 65 plus deduction, that's 2,000. Then this new addition at 65 plus for 6,000, for a total of 23,750. And if you're a married couple, that total could be 46,700. 529 plans are plans that are specific to saving for college or now grades K through 12. When they first came out, they were college only, and then they expanded them to tuition for ages or grades K through 12. Well, now they've expanded that to a withdrawal amount of $20,000 per year. However, it can also be used beyond just tuition. So textbooks, instructional material are approved, tutoring, standardized tests, dual enrollment fees. So if you're taking college classes in high school and there's a fee associated with those, that could be used to pay that fee. And then also educational therapy costs for students with disabilities, including occupational, behavioral, physical, speech, language, and therapies. Auto loans have a temporary reprieve in 2025 to 2028, but there are a bit of rules and regulations involved in getting that deduction. Well, first, it's applicable only to new passenger vehicles, so no campers, RVs, ATVs, or used cars, and they have to have a final assembly in the US. I've noticed that in some commercials, they're starting to add final assembly in the US. It's limited to $10,000 in interest annually, and it does have income limits. So if you're single, $100,000 is the cap, and then $200,000 for married filing jointly. The deductibility is itemizers and non-itemizers, and it applies only to interest on loans for new vehicles that were purchased after December 31st of 2024. So interest on older loans isn't deductible, and taking out a new loan on a car that's already been paid off does not qualify. Now, tax on tips and overtime, that's been a lot discussed in the news. And so we'll start with tips. So as a single or married filing joint individual, you can deduct up to $25,000. And of course, they have to be voluntary tips. And we'll talk more about what qualifies for that. For overtime, the amount of deduction is $12,500 if you're single and $25,000 if you're married filing jointly. Again, but it's only on the premium portion of the overtime pay, and I'll explain that later in my example. Both of them are available to itemizers and non-itemizers, and both of them have caps. So if you're single, 150,000, married filing jointly, 300,000, and then there are phase outs after that. So let's have an example regarding the tips. So Sally's a waitress, and her career is one that the IRS deems customarily and regularly received tips. So she can deduct her tips. But John is a mechanic, and if he does receive a tip, it is not deductible because tips aren't common in his profession. And there are 68 professions that have been outlined by the IRS. And you can find that on their website. However, if John, as a mechanic, earns $30 an hour, but he gets 45 for overtime, that extra $15 per hour would be tax-free and count towards the annual limit. The regular $30 base pay would still be taxable. There's a new account called a Trump account, and that starts next year, 2026. The initial deposit for U.S. citizens born between January 1st of 2025 and December 31st of 2028, there'll be $1,000 deposited when an account is open, and that is from the government. Now, older children can participate in a Trump account, but they are not eligible for that $1,000 contribution. The amount that can be added to that account each year is $5,000, and that will be indexed for inflation, so that will gradually raise. The tax treatment is similar to that of a traditional IRA, where the savings grow tax deferred, and then you're taxed on the gains when you make withdrawals. At age 18, the account transitions from the parent to the child as an IRA. Now, these accounts aren't available to open today, but they're starting in July of 2026. They'll be available most likely through banks or investment firms like Star Group Wealth Management. Charitable deductions and credits. So starting in 2026, permanently reinstates the non-itemizer partial charitable contribution deduction and increases it to a maximum of $1,000 for a single individual and $2,000 for joint returns. But it must be in cash, given directly to the charity. It can be investments or through a donor advised fund. Starting in 2026, there's a new rule that will limit how much your charitable donations can be deducted if you itemize. So you'll only be able to deduct the portion of your donation that exceeds 0.5 or 0.5% of your adjusted gross income. And then in 2027, donors can get a tax credit of up to $1,700 for giving to scholarship organizations that support K through 12 education. And any unused credits can carry forward for 5 years. There are some miscellaneous rules. So the health savings account, or HSAs, have only been available to high deductible plans, considered gold and silver plans, where they're expanding that to bronze and catastrophic plans, so they can also take advantage of HSAs, or health savings accounts, which are great investment accounts because they allow you to take a deduction on the contribution, and then you don't have to pay taxes on the withdrawal if used for medical expenses. Educators in 2026 who pay for classroom materials, they can claim this deduction, but they do need to itemize. Now, this last one, I don't like this last one because it is taxing phantom income. Here's my example. So you go to the lottery booth and you get a ticket and you win $100,000. You take that 100,000, you go to Vegas, and you lose it all. Well, you would still have to pay taxes on 10,000 because only $90,000 of gambling losses are allowed. So even though you didn't make any money, you'd still have to pay taxes. Don't like that. Now, there are some impacts to companies. We're not going to get into the details of those, just maybe some big picture, but to give you an indication of how that impacts you as an investor. So there's 100% bonus depreciation on U.S. R&D, research and development expenditures, but only here in the U.S. And this reduces the taxes for companies, which increases their revenue, which increases their share price, which brings the markets up. So that's positive for the markets. And there are many sectors that are beneficiaries of the bill, and that would be semiconductors, autos, pharmaceuticals, manufacturing, and then US investment from companies abroad, opening up plants here. A lot of auto manufacturers are taking advantage of that so the car can be completed here in the US. On a personal side, the tax reductions that I talked about in the very first slide, that really encourages consumer spending. People have more money in their pocket, they're going to spend. Our economy is based on the consumer and spending. And then also, when tax rates are low, which these tax rates now are considered historically low, people are more likely to pay their taxes. They feel like they're more fair. And so what happens there is the government actually brings in more taxes, and hopefully that will help pay down our debt. So in summary, overall, the bill allows for certainty when we're talking about taxes and estate planning. Very good for a planning firm like ours, allows us to be more accurate when putting our plans together for our clients. It does provide opportunities for long and short-term planning, and that's, again, helpful. And then also understanding how these tax changes affect you and your family really helps you and your financial advisor, your CPA, your estate planner make better decisions for you. And we didn't talk about the impact to the debt, and we didn't talk about other factors. If you are interested in finding out what those numbers might be, the Tax Foundation is a great resource, and they have a page set up specifically about the One Big Beautiful Bill Act and where they are estimating taxes. So if we're reducing taxes, how does that affect the deficit, et cetera? So that's a good place, and they're constantly updating that. The information as it comes in, as the tariffs have been finalized, there'll be updates on that site. So it's a good site. It's considered a nonpartisan site. It's a nonprofit. They've been around for 80 years and just a great resource if you're looking for the impact of the bill. So I thank you very much for joining us today, and we are available if you have any questions regarding the bill, and we can be reached at www.star-tx.com is our website, and our phone number is 713-783-3400. So again, thank you. I'm Leslie Stock Lopez, and I hope that this bill finds you and your family great impacts for the future. Thank you.